Welcome to StokTok's deep dive into HSBC Holdings. HSBC is one of the world's largest multinational banking and financial services organizations, with a presence across more than 80 countries and territories. The company generates revenue through personal banking, commercial banking, investment banking, and insurance operations, serving millions of retail and institutional clients globally. Its scale and geographic diversification are its defining characteristics. Over the past 52 weeks, the stock has traded between $57.85 and $94.80. As of Friday, May 8th, the stock is trading at $90.16, positioning it modestly below its 52-week midpoint. Let's work through the fundamentals, scene by scene, starting with a quick business overview. HSBC generates revenue through multiple business lines: personal banking, mortgages, deposits, and consumer lending; commercial banking, providing credit and treasury services to mid-market and large corporations; investment banking, advisory and capital markets operations; and a significant insurance subsidiary offering life, general, and investment-linked products. The company's competitive moat rests on three pillars. First, its global branch network and presence in strategic emerging markets creates switching costs. Customers value consolidated banking across geographies. Second, its substantial capital base and investment-grade credit ratings enable it to price competitively and fund operations efficiently. Third, its institutional client relationships in investment banking provide recurring fee revenue with high margins. However, the banking sector overall faces structural headwinds from low interest rate environments and rising regulatory capital requirements. Our StokTok score on this stock is 30 out of 100, which signals we view it as a company to avoid. Breaking that down, valuation scores 4 out of 20, financial health scores 9 out of 20, profitability scores 10 out of 20, growth scores 5 out of 20, and smart money positioning scores 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? HSBC is trading at a price-to-earnings multiple of 14.52 times, based on trailing 12-month earnings. This sits below the historical average for large-cap financials, which typically command multiples in the 15 to 18 range. However, the forward price-to-earnings ratio, what investors are willing to pay for the next 12 months of earnings, is 10.26 times, which suggests the market is pricing in earnings pressure ahead. The price-to-earnings growth ratio, or PEG, comes in at 3.49. PEG ratios above 2 typically signal limited upside from a growth perspective. An HSBC reading indicates investors are paying a premium for minimal expansion. The enterprise value to EBITDA multiple cannot be calculated from available data and warrants investigation, often a red flag in financial analysis. Wall Street analysts have a consensus mean price target of $109 based on 3 analyst estimates. The high estimate reaches $132, while the low estimate sits at $94. This implies upside of approximately 21% from current levels to the consensus target. However, the wide spread between high and low targets, a $38 range, reflects significant disagreement among analysts about the company's fair value. Turning to earnings. In the most recent quarter, HSBC reported earnings per share of $1.85, beating the consensus estimate of $1.80. However, revenue came in at $19.12 billion, significantly below the estimate of $63.77 billion. This miss demands context. The revenue figure likely reflects a reporting adjustment or segment-specific metric rather than the full company, as this discrepancy is unusually large. That said, the earnings beat is encouraging. The company posted net income of $7.34 billion in that quarter, and revenue grew 47.9% year-over-year, indicating strong operational leverage despite the revenue estimate miss. Market sentiment around HSBC leans bearish. The company faces headwinds including flat first-quarter profits, expectations of further credit losses in a potentially weakening credit cycle, and broader uncertainty around global economic growth. The insurance subsidiary does show resilience with solid growth, providing some offset to core banking challenges. Balancing the low entry-level valuation against modest growth prospects and balance sheet concerns, we view HSBC as fairly valued to slightly expensive. In our view, a reasonable fair value range sits between $90 and $115, with the consensus analyst target of $109, representing a reasonable midpoint to monitor. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which measures 9 fundamental accounting quality metrics, comes in at 5 out of 9 for HSBC. This score of 5 indicates mixed financial health. The F-score examines profitability, operating efficiency, and balance sheet quality through signals like positive earnings, cash flow from operations versus net income, asset quality, and debt levels. A 5 suggests the company is neither in robust condition nor deeply distressed, but warrants close monitoring of credit quality and operational trends. The Altman Z score, a model that predicts bankruptcy risk using 5 financial ratios, returns 0, a value that typically indicates distress territory. This is a material red flag. However, Z-scores can be less reliable for banks than for industrial firms due to the nature of balance sheet leverage in financial institutions, so we must contextualize this reading. It should heighten skepticism, but not trigger panic. Turning to debt and liquidity, the cash-to-debt ratio stands at 1.20, meaning HSBC has $1.20 of cash for every dollar of debt. This is acceptable and indicates the company can service obligations, though it is not fortress-like. Interest coverage, earnings available to pay interest on debt, cannot be calculated from available data. The current ratio, which measures short-term liquidity, also cannot be calculated. The debt-to-equity ratio is 1.29, indicating the company carries $1.29 of debt for every dollar of shareholder equity. For a bank, this is not unusual, as financial institutions operate with higher leverage than industrial companies by design. However, combined with the weak F-score and Z-score, this suggests the balance sheet offers limited cushion against a credit cycle downturn. In summary, HSBC balance sheet is adequate but not strong. The company can meet near-term obligations, but there is limited margin for error should credit losses accelerate or deposit funding tighten. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, cannot be calculated from available data, which is unusual and makes it difficult to assess how effectively management deploys shareholder capital. Gross margin and operating margin likewise cannot be calculated, likely because HSBC revenue structure, predominantly net interest income and fees rather than product revenue, does not map cleanly to traditional margin analysis. However, net margin, which shows what percentage of revenue drops to the bottom line as profit, comes in at 33.76%. This is remarkably strong and indicates the company is converting revenue into net income efficiently once all costs, taxes, and financing are accounted for. The free cash flow margin, cash generated from operations minus capital expenditure, expressed as a percentage of revenue, is 37.91%. This is exceptional and suggests HSBC generates substantial cash relative to earnings, providing flexibility for capital deployment and shareholder returns. In the most recent quarter, the company posted net income of $7.34 billion on revenue of $19.12 billion, consistent with these strong margin readings. The combination of a 33% net margin and nearly 38% free cash flow margin tells us HSBC is operationally profitable and cash generative. However, these metrics must be viewed alongside the weak balance sheet signals. A fortress margin profile is less valuable if credit losses are rising or capital adequacy is deteriorating. In summary, HSBC profitability profile is strong on a standalone basis, but profitability alone cannot offset balance sheet and growth concerns. On to growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years averaged 3.9% annually. Over the trailing 5 years, Revenue growth averaged 5% annually. Both figures are pedestrian for a global financial services company and signal limited organic expansion. In the most recent quarter, the company posted revenue growth of 47.9% year-over-year. This dramatic acceleration requires context. The comparison is to a depressed prior year quarter, likely impacted by economic weakness or one-time items. A single quarter of strong growth does not erase the longer-term trend of low single-digit expansion. Book value, which represents shareholder equity per share, has grown at 5.7% over the trailing 3 years. This modest rate reflects earnings retention and limited capital gains from equity holdings. The dividend yield is 4.46%, which is generous by equity market standards and indicates management is returning capital to shareholders rather than reinvesting for growth. This is typical for mature financial institutions, but signals limited organic expansion prospects. Management has guided toward consensus earnings of $2.28 per share for the next earnings cycle in August of 2026, offering a modest growth trajectory. In summary, HSBC is a slow growth business. The company is not in secular decline, but it faces structural headwinds, regulatory requirements, competitive pressure, low interest rates in key markets that constrain expansion. The high dividend yield is attractive to income investors, but signals the company lacks compelling reinvestment opportunities. Now let's talk smart money. What institutional capital is actually doing with this name? According to our data, 6 top-tier investment gurus currently hold HSBC stock, indicating some institutional conviction. However, this conviction is not particularly strong. Only 4.2% of the 13F filing institutional investors, the quarterly filings that professional money managers must disclose, are net buyers of HSBC, meaning they increased positions in recent quarters. A reading of 50% or above would signal broad institutional bullishness. 4.2% is essentially neutral and suggests institutions are neither rushing to accumulate nor aggressively exiting. Of those Guru holders, Richard P. Zena, who manages P. Zena Investment Management, holds 0.01% of his portfolio in HSBC and recently added to the position, increasing it by 4.56%. P. Zena is known for value investing discipline, focusing on companies trading below intrinsic value with hidden asset value. His small but growing position suggests he sees valuation appeal, though the minuscule allocation indicates this is not a core conviction. Insider ownership, the percentage of shares held by company executives and board members, is extremely low at 0.14%. This is a significant red flag. When insiders own minimal stock, it suggests they lack personal financial skin in the game and may be less motivated to maximize shareholder value. Over the past 3 months, insiders executed 1 buy transaction and 0 sells, a modestly bullish signal that at least one insider found valuations attractive. However, the absence of aggressive insider buying, combined with near-zero insider ownership, signals limited internal conviction. In summary, smart money positioning in HSBC is weak. Institutional investors are neither accumulating nor fleeing, and insider ownership is negligible. The lack of conviction from those closest to the business is a material concern. And finally, the verdict. Let's bring it all together. On valuation, HSBC trades at 14.52 times trailing earnings with a forward multiple of 10.3, positioning it below historical sector averages, yet the PEG ratio of 3.49 and analyst disagreement argue for caution. On financial strength, the balance sheet is adequate but not fortress-like, with weak scores on the Piotroski and Altman models, signaling limited margin for error in a credit downturn. On profitability, margins are exceptionally strong at 33 to 38%, reflecting operational efficiency, but profitability alone cannot offset growth and balance sheet headwinds. On growth, HSBC is a slow grower, expanding at 3 to 5% annually with a generous dividend that signals capital return over reinvestment. On smart money, institutional conviction is minimal, insider ownership is negligible, and the recent insider transaction, offers only modest support. In our view, a fair value range for HSBC sits between $90 and $115, representing approximately upside of 0 to 27% from current levels. The most recent quarter delivered an earnings beat, which is encouraging, but the revenue miss and bearish sentiment on credit outlook warrant caution. HSBC is a mature, profitable, dividend-yielding financial institution trading at a reasonable valuation. However, it faces structural growth constraints, balance sheet vulnerabilities, and minimal insider or institutional enthusiasm. We view the setup as lacking a compelling catalyst for multiple expansion. The thesis rests on the assumption that the dividend yield and valuation floor protect downside risk, but deteriorating credit quality or capital requirements could pressure both. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on HSBC Holdings. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.